I put all my emergency savings into a money market fund. It felt safer than stocks. Is that okay?
It's definitely safer than putting everything into stocks, but it's not the same as keeping cash in the bank. Money market funds still carry certain risks that people often overlook.
Risks? I thought they were basically like cash with a little extra yield.
That's the common belief, but not the full story. Money market funds aim to be stable, but they invest in very short-term debt instruments, things like government bills, certificates of deposit, or corporate paper. These assets can fluctuate if interest rates change or if one of the issuers defaults.
Wait, so the value of my money market fund can actually go down?
Yes. It doesn't happen often, but it can. In 2008, during the financial crisis, one of the largest money market funds broke the buck, meaning its value fell below $1 per share. Investors who thought they were holding cash suddenly saw losses.
Wow, I didn't know that. So interest rates can hurt too?
Exactly. When rates rise quickly, the short-term bonds inside the fund lose value before they mature. The fund manager can usually adjust over time, but in the short run, returns may fall or even turn negative. It's not guaranteed protection.
So if I use money market funds for emergencies, I might not have all my money when I need it most?
That's the key risk. Emergencies require instant liquidity and absolute safety. If your car breaks down or you lose your job, you don't want to wait days to access your money or risk that the fund has temporarily lost value.
So are money market funds bad? Should I avoid them completely?
Not necessarily. They can play a role. They're useful for parking short-term cash you don't need immediately and for earning a little interest above a checking account. But they are not a substitute for true emergency savings.
Then where should real emergency savings go?
Always keep a portion, at least 3 to 6 months of expenses, in an insured savings account or a simple bank deposit. That money might not earn much interest, but it's guaranteed to be there when you need it. Liquidity and safety are more important than yield in emergencies.
And the rest of my cash?
Once your core emergency fund is secured in cash, you can use money market funds for extra liquidity or as a short-term holding place before investing. That way, if something unexpected happens, you still have a cushion that can't lose value.
I see. So it's about balance. Some in savings, some maybe in a money market fund, but never 100% in one place.
Exactly. Think of it as layers of protection. Cash in the bank is your shield against emergencies. Money market funds are more like tools for managing short-term money flows. They're helpful, but they shouldn't be your only defense.
That makes sense. I guess I was chasing the higher yield and forgot about the actual purpose of an emergency fund.
And that's common. People want every dollar to work harder, but sometimes safety matters more than growth. Protecting your financial stability should always come first. And if you want more practical tips on how to balance safety with smart investing, follow us and check the link in bio for our monthly stock picks.